Okay, I'm going to talk about mortgages and home equity lines of credit in this video. So first of all, with mortgages, one of the big myths out there is a lot of people like to put extra money every month towards their mortgage and pay it down faster over time. And I always recommend to people, if you want to pay your mortgage down faster, then instead of taking that extra couple $100s a month and paying it direct to your mortgage, take that money and put it into a savings account, whether it's just a plain savings or money market account, or you may decide to put it in a taxable investment account and get a little bit of return on it. And the reason for that is when you pay the additional payments directly to your mortgage, that money is really tied up. The only way you can get that back out is to refinance your house. I've seen so many situations where people's life situation changes and they really wish they had access to that money. So I would recommend, if you're thinking about doing that, just put in a savings account instead. Also, people may be asking, when is a time to refinance? Well, I'll tell you that right now, if your mortgage rate isn't close to 4% or lower, maybe you should consider refinancing now. However, we're in a period of time where interest rates are going up, and so that won't always be the case. Other times you may want to refinance is if you're getting ready to remodel your house. You may do what's called a cash out refinance, where you can go and refinance, and if you've developed equity in your account, that's the difference between the balance on the mortgage and the value of your home, that you could actually go and take some of that cash out in order to pay for and fund a remodel or a renovation. As always, I just recommend just make sure that you can afford it. Run the numbers, look at your budget, make sure that you really understand the implications of taking on more debt, and make sure that you feel really comfortable doing that. So then I'm going to talk about home equity lines of credit. And the way that a home equity line of credit works, it's similar to a credit card, but it is linked to the value of your home. And so what the bank will do is, let's say that you have paid down your mortgage to the point where your mortgage is only 70% of the value of your total home. Banks will usually offer you a line of credit for up to 80 or 90% of the value of your home. And what they do is, first of all, they come out and they appraise your home. And if it's approved, then they send you a checking account. Often they're sending you a debit card as well. And you can use that for expenses that you may have. So sometimes I will recommend that people pay off car loans with a home equity line of credit. And the reason why is because a home equity line of credit, the interest on it is tax deductible. And so again, you have to look at what the interest rate is between your car loan and the home equity line, but often it does make sense to pay off car loans with home equity lines. I also like it for people that maybe have fluctuating income and just need a little bit of an extra buffer. Maybe they haven't been able to save up their emergency fund, and this could be another source. Additionally, a home equity line can be used for improvements on your house as well. Really, the money can be used for anything you wanted to. However, I don't recommend you take the money and head to Vegas and blow it all. So try to be responsible with this money that you would use on your home equity line. And then you have some flexibility on how you pay it back. You'll have to pay a minimum amount back every month that's based off of the amount on the home equity line and the interest rate. But on this type of loan, I often do recommend for people to try to pay it off faster, to pay off a little bit extra each month to get that paid down over time.